First of all, let's deal with timing issues, matching of revenue and expenses, correcting and adjusting journal entries. Now, first of all, some very fundamental stuff, the terminologies. We have assets, liabilities, right? Those are pretty obvious items. Now, with revenue, I'd like you to go down to C1, and let's highlight some information as we discuss it. Revenue recognition, and this is under U.S. GAAP. So let's highlight that, and then underscore U.S. GAAP, because later on we'll show you some unique characteristics of international reporting, which of course is tested on the CPA exam, and you want to make sure you can distinguish the two. All right, requirements, let's highlight that and then go down to 1. All 4 criteria must be met for each element of a contract before any revenue can be recognized. So here are the 4 criteria, and let's highlight each of these 4. Persuasive evidence of an arrangement exists. Now, after you've highlighted that, why don't you kind of put down a general concept here? And these are just general concepts. There are certainly exceptions to each of these. But what that really means is you want a signed contract. All right, why don't you put that in your notes? Yes, there are exceptions, but on the CPA exam, you'll almost always see that there was a signed contract or a confirmation in writing. All right, letter B. The second of the 4 criteria. Let's highlight. Delivery has occurred or services have been rendered. And after you've highlighted that, let's put down what that really means. Put down risk and rewards transferred. The risks and rewards of ownership have been transferred to the customer. All right, the third of the 4 criteria, let's highlight. The price is fixed and determinable. Let's highlight that. And then next to that, put down no price contingencies. No price contingencies. Now, by price contingencies, we're referring to the idea that maybe they get a retroactive volume discount, like 10%. If you buy over $1 million during the year, we give you back 10% of whatever you paid. Then you've got to withhold 10% from being called revenue, even at the beginning of the year, even if it's remote that they'll ever hit that number. The next item, and this is the 4th and final element, collection is reasonably assured. Collection is reasonably assured. Highlight that. And then next to that, put standard collection terms. If you've ultimately given somebody 3 years to pay, there's a possibility that you'll have to make some concessions later on. So hence, that would, again, possibly delay it. Or if, again, you have to make other types of concessions that are not legally required to be made, that would be a situation where revenue may have to be deferred. So those are the 4 criteria. They must all be met in order for you to recognize revenue. Now, let's just read this next item, and I'm going to ask you to underscore and circle 1 or 2 key words, because now we're going to deal with different types of revenue, products, services, subscriptions. So I just want you to highlight by underscoring 1 or 2 critical items. Underscore revenue in number 2. And then let's read. Revenue from the sale of Circle products or the disposal of assets is recognized on the underscore date of sale. So revenue from products is date of sale. All right. Next item. Still reading and just circling and highlighting as we say. Revenue that stems from allowing others to circle use of the entity's assets, such as money, etc., where you charge interest. Again, using, some of your products where you charge royalties. Using property, which you would charge rent.